past few weeks have undoubtedly tested investor resolve. Global tariffs have acted as a negative catalyst, contributing to the fifth biggest equity decline in roughly 75 years. As outlined in our 2025 outlook, expectations for economic and earnings growth were already at ambitious levels, especially following 2 consecutive years of strong performance. I'm Michael Drozd, CIO at LaSalle Street. Stay tuned to learn why the repricing of the U.S. stock market was somewhat anticipated and why the bond market is currently in the driver's seat. Recent weeks have been transformative for asset markets. The Trump administration's strategic maneuvers are being challenged by multiple opponents, each with their own advantages. The risk of significant capital outflows from the U.S. assets, specifically U.S. Treasuries, has played a crucial role in President Trump's about-face. And from a broader perspective, the White House may recognize that continued stock market losses could weaken its leverage in tariff negotiations. If stocks decline too sharply and bond yields rise, the bargaining position could deteriorate. And in the near term, although this about-face may bode well for a rebound in U.S. stocks, a lower U.S. dollar, lower bond yields, and lower commodity prices contribute to an easing of financial conditions, creating a more favorable environment for risky assets and the economy in the near term. The question now is, will the bond market and bond yields cooperate? Historically a safe haven asset, U.S. Treasuries and the U.S. dollar appear to be out of favor, with yields rising and the U.S. dollar at its lowest level in 3 years, all while international investors are selling U.S. assets. Current economic data does not indicate that a recession is imminent. Hard data on industrial production, consumption, and payrolls remain stable, while consumer confidence and sentiment appear to be challenged. It is possible that sentiment could erode hard data in the coming months, but we are not there yet. In fact, with financial conditions easing, this may even extend the economic cycle. Employment data does not currently signal a developing recession. However, they are approaching critical threshold levels. Further deterioration in employment data could provide justification for the Federal Reserve to ease monetary policy further. Additionally, bond market volatility may compel the Fed to provide more stability, as private investors could be crowded out of new issuance in the future. Rising deficits coupled with the extension of the Tax Cuts and Jobs Act are creating increasing debt loads for the U.S., making the U.S. Treasury market appear less resilient to shocks. In conclusion, the recent equity market reversal, macroeconomic, and bond market data do not yet indicate an out-of-the-woods scenario, and a more cautious view remains warranted in the near term. However, for long-term investors, the most recent pullback may be a good entry point. Thank you for watching A View from the Street, and for more information, be sure to check out our most recent From the Office of the CIO publication. Thanks again.